$87.28. Silver just spiked to that number this week. That move happened in 4 days. For days. The Middle East conflict is in its 5th day now, and the silver market has realized something that most retail investors have not caught up to yet. Global supply chain for metals are under direct threat, not theoretical threat, direct threat. Last week I told you to watch one specific threshold. I said if COMEX registered inventory drops below 105 million ounces and the Shanghai premium stays above 8%, everything changes. Both conditions just hit simultaneously this week. Here is what that means. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I watch what happens when retail investors get the wrong information at the wrong time. That is why I am here. Everything I show you today comes from publicly available sources. I will name every one as we go, so you know exactly where it is coming from. If this kind of calm, data-first breakdown is what you've been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. So here is what we are actually looking at this week. Silver broke $87 on Tuesday morning. The move itself was not surprising given the geopolitical situation. What was surprising was the speed. Silver moved $4 in 4 days. That is a 12% move in 96 hours. In 15 years watching commodity markets, 12% in 4 days usually happens for one of two reasons. Either there is panic buying or there is forced liquidation. In this case, it is panic buying. And panic buying into a market with shrinking physical inventory is a different animal than panic buying into a market with plenty of supply available. The U.S. dollar index is sitting at 98.88. 3 weeks ago, it was above 101. The dollar has weakened significantly. In a normal world, a weakening dollar alone would support silver prices because it makes silver cheaper for foreign buyers. But the dollar weakness did not cause this move. The dollar weakness did not start until 2 weeks ago. Silver started accelerating this week. The real catalyst here is a geopolitical shock colliding with a specific structural condition in the silver market. That structure is inventory. The COMEX warehouse data I pulled this morning shows that registered silver inventory, the metal available for delivery, just hit 103 million ounces. 103 million. That is the lowest level in the data I can access. The previous low was 108 million ounces. We just broke through that. This is not a gradual trend. This is an acceleration. In the past 3 weeks alone, registered inventory dropped 6 million ounces. 6 million ounces in 21 days. If that rate continues, and I am not saying it will, but if it does, the entire registered pile will be gone in 360 days. Obviously, that will not happen because the system will break before that occurs. But think about what that math tells you. The drain is accelerating, not stabilizing. The Shanghai premium is the story behind the story. Shanghai is trading at $94.85 right now. COMEX is at $87.28. That is a $7.57 difference. That is 8.7%. That premium is not random noise. That premium exists because physical metal in Shanghai is scarce relative to COMEX. Investors in Asia are willing to pay 8.7% more because they believe Eastern metal is harder to access than Western metal. When that happens, it creates what I call a magnetic pull. Western metal flows east because the premium is worth the shipping and the arbitrage. Think of it like a vacuum. Shanghai is the vacuum. COMEX is the source. And the two between them is the Shanghai premium. The higher that premium, the more aggressive the flow. 8.7% is a vacuum at full strength. The interesting thing is what this tells us about where smart money actually thinks the problem is. If the concern was purely financial, if this was just about rates or currency, then we would expect to see the premium compress as supply got tight and buyers got nervous. Instead, the premium is expanding. That tells you the concern is physical scarcity. That tells you institutions believe the problem is not economic. The problem is physical. The problem is that there is not enough metal in the places where people want to take delivery. The geopolitical layer here is unavoidable. The Middle East conflict is in its fifth day. Energy prices are rising. Oil is up 8% since the weekend. That matters for silver because silver is used in industrial processes that require energy. But more importantly, geopolitical risk changes how institutions think about counterparty risk. When geopolitical tension rises, institutions start worrying about whether their metal is actually safe where it sits. They start worrying about whether exchanges will restrict withdrawals. They start worrying about whether governments will impose capital controls. Those worries are not crazy. They are historical precedent. When geopolitical risk spikes, metal starts moving from vaults to private hands. That is what we are seeing. The LBMA data from London shows vault inventory actually declining despite elevated physical demand. That usually does not happen. Usually when demand is strong, vault inventory stays stable because institutional buyers are happy to hold metal in auditable storage. When vault inventory declines during strong demand, it means institutions are taking physical delivery and moving it out of the institutional system entirely. That is a structural shift. That is a sign that institutions believe they need to own the metal, not just have a claim on metal in a vault somewhere. The CME data I looked at this morning shows something that actually stopped me. Open interest in silver futures is sitting at 577 million ounces. That is a massive number. But registered inventory, actual metal available for delivery, is only 103 million ounces. That is a 5.6 to 1 ratio. 5.6 claims for every 1 ounce of actual metal. In a normal market, that would be concerning but manageable because not all open interest converts to delivery. But we are not in a normal market right now. We are in a market where the Shanghai premium is expanding, where vaults are draining, where geopolitical risk is spiking. In this environment, the psychological pressure on that 5.6 to 1 ratio becomes extreme. Traders start asking themselves, what if everyone on the long side of these futures contracts decides they actually want delivery? What if they all decide they do not want paper claims anymore? What if they want the actual metal? The moment that question enters the market, the leverage becomes a liability instead of an asset. That moment appears to be arriving. The institutional behavior we are seeing right now is different from normal market participation. The data I pulled from the CME shows that managed money net longs in silver just hit a 2-year high. But here is what is different from normal. The commercial shorts, the dealers and miners who usually provide liquidity by selling futures, they are conspicuously absent. They are not showing up to sell into this strength. Why? Because they do not have the physical metal to deliver against new shorts. If they sold futures right now and got assigned for delivery, they would have to buy metal in the spot market to cover. At 8.7% premium to get Shanghai metal to COMEX, that is not profitable. So they are not selling. That means there is no natural seller stepping in to cap the move. That means the pressure valve that usually releases is jammed. Now, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. Blue lane. COMEX positioning is extreme. Managed money net longs at 2-year highs. Commercial shorts absent. That is a severe imbalance. In a normal market, that setup corrects when one side gets nervous and starts liquidating. But in this market, the long side is not nervous. They are convinced. They are holding. They believe the squeeze is real. That conviction is what turned the leverage problem into a systemic problem. Lane 2, the physical market. Silver lane. Premiums at 8.7%. Vaults draining across London and New York. Private demand for physical delivery accelerating. LBMA inventory declining despite strong demand, which is the opposite of what normally happens. That is a structural shift. That is institutions moving metal out of the institutional system. Lane 3, macro. Gold lane. The geopolitical situation escalating, not de-escalating. Energy prices rising, dollar weakening. Central banks not intervening to stabilize the situation. Fiscal risk rising as governments prepare emergency spending. When all 3 lanes align like this, when paper is leveraged, physical is draining, and macro is deteriorating, Historically, that has preceded some of the most significant moves in commodity markets. Not always, not guaranteed, but often enough that professionals take it seriously. I am not saying a supply breakdown is imminent. I am saying the conditions are present for one to develop if geopolitical pressure continues. Here's the one thing I am personally watching this week. One thing. Silver closing above $88. If silver closes above $88 and hold that level into next week, that tells me the institutional conviction is genuine and the move is structural, not just emotional. If silver rolls back below $85, that tells me it was a panic spike, and we might see a retracement. That is my watch. That is my specific call. This is my one call for the week. John, FX Insider. On record. I am putting it on record right now, and I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Middle East tensions escalate further. Energy costs spike. Silver breaches $90 and tests 92. The Shanghai premium expands further as supply continues to drain. Institutions panic cover shorts. The move accelerates toward 100 or beyond. That is the bull case, and it is based on real structural conditions and real geopolitical deterioration. Here is what needs to happen for the cautious picture instead. Diplomatic breakthrough in the Middle East. Energy prices stabilize. The geopolitical premium comes out of silver. Institutions take profits after a $4 move in 4 days. Silver corrects back toward $82.50. Premiums compress as supply pressure eases. Both are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First question, are you seeing this 8.7% Shanghai premium reflected in your local dealer pricing right now? Or is your dealer still pricing off COMEX? Drop that answer below. Second question, if this Middle East situation escalates and silver hits 90, do you think you hold or take profits? Drop both answers below. The comments section here becomes a real-time sentiment tracker, and I read every single one. Before the final word, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. Subscribe, because next week we're going into supply chain vulnerability assessment, and I will show you exactly how to identify which industrial metals are in actual short supply. That is a skill worth having. And if someone in your life is holding silver and watching this move and does not understand what is actually happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.